There are a lot of reasons why a trader might not execute their trading plan properly, and not wanting to be wrong is a big one. And if you've been trying for any length of time, you understand that it's impossible to take winners 100% of the time and avoid all your trading losses. And for those that are just beginning to trade, the fact that you will lose is a lesson all in itself. All the data on your charts is historical, which means you're only able to assess what has happened already. And everybody is perfect in hindsight. And as smart as you are, you can never really know who is sitting ready to act, and so a big trade or an unexpected event could change everyone's perspective of what a fair price currently is, regardless of what is traded before. Then there's the fact that the market can make you wrong for a tick whether or not the concept for a specific trade was valid or not. Until you've closed a trade, you cannot be certain that it will achieve your profit target. An ego in trading is a mistake. We know we're going to be wrong at various points in our trading. And what's the reason why we often see traders having a hard time in letting go of unsuccessful trades? Surely by knowing that we're going to take a losing trade on any given day, it should be easy to just click the mouse and exit the trade, right? Wrong. And I believe it's not really anything to do with being wrong at all, but all about the way in which a trader loses that leads to many of the problems that they face. And trading is not about being right. We have a deeply ingrained aversion to being made to feel or look like a fool. Perhaps this is down to evolution and a drive for a mate, but it's certainly observable in many walks of life. People often revel in denigrating those who have said or done something silly or naive. Many a comedy moment is centered on this type of a thing. Think Homer Simpson. At many mainstream schools, much of the learning is focused on being right or wrong, as opposed to reasoning. Part of the problem with producing genuinely capable people at the end of the education, rather than people who have learnt to pass an exam. And so it is with trading, that not being made to feel like a fool, not having your money taken from you in a silly way, and proving to yourself that you really do know what you're doing, can become a millstone around a trader's neck. And this taps into some pretty strong instincts, ones which, when we're already in a heightened state of emotion, can be extremely difficult to negate. The compounding effect of multiple experiences can lock you into a negative behavior pattern until you're really able to recognize what's going on. And here's a sample of situations that you might be able to relate to. Getting stopped out to the tick again. You don't want to be the sucker at the table who keeps getting their stop taken out right before the market moves to their target. And this can lead to trading on the edge to try to exit out of the position when your price starts to get traded out. The problem with this is that there's a seemingly invariable jump through your price and you end up missing your exit. Another observation is where a trader just keeps moving their stop until they are so committed to the trade that they refuse to take the loss at all. And you skip parts of your trading plan. You take a loss because you missed an important piece of information that's normally part of your decision-making process because either you weren't paying attention or you didn't prepare properly. You want to avert this feeling of being inadequate and acting in a stupid way, and so only take high probability setups. In reality, ones which you feel will definitely be winners. So when they lose, you either refuse to accept a loss or you feel betrayed by the market. You don't ever want to miss a move. The market keeps acting in a certain way that it doesn't usually do, and you're taking loser after loser because of this. And you don't want to feel like a fool when you stop trading and it reverts to its usual self, so rather than sit on your hands, you keep trading and taking losers. Either this or you start trading off your plan, which could just be a disaster. You start to feel like you know what's going to happen while you're in a trade, so you mess with your plan on the fly. Trading for revenge. You take an impulse trade that ends up losing, and you know you should have followed your plan instead. Rather than trading your plan, you try to make up for it by taking further impulse trades while digging yourself into a deeper and deeper hole. And if you can never truly be right on a trade, how can you ever really be wrong? Your trade outcomes are never wrong. We appreciate we're going to take losses in our trading. So what does never be wrong again actually mean? Trading is as much to do with changing your mindset and therefore behavior as it is to do with strategies, money management, and everything else. Perhaps more so, as everything else is dependent on how well you grasp these concepts. Being right is not about taking winners, and you can do some real damage when you profit with poor logic. Being rewarded for bad plays will cause you to repeat the mistakes. It's about being able to assess a situation, which is more likely to happen next, and apply a strategy properly and consistently where appropriate. If your reasoning is sound and you take your trade, you've done the right thing in spite of the outcome of the individual trade. You've identified your trading edge and you've given it the opportunity to play out in the market. But if being right is about taking a trade and not the outcome, then surely you can still be wrong, of course, but not how you think you can be wrong. The point is that if you view it this way, focusing on the act of trading, your focus is on trading properly. You can never be wrong about the outcome because you already know it's uncertain. The only thing we can fully control in trading is when we trade and how we trade. The proper way of being wrong, the only way in an uncertain environment, is not doing what we know we should do. In order to give yourself the best possible chance of assessing an opportunity correctly and executing your strategy consistently, there are a few simple, but uncertain, there's no concrete right or wrong, steps that you can take. Number one, you need a clear and simple enough plan of how you will trade and under what conditions. Number two, leaving the level of discretion to a minimum. Number three, by monitoring market conditions, for example, as simple as whether the market is trending or consolidating, you can understand when this strategy is likely to work better and therefore what you should be looking for leading up to a trade. So strip the word wrong from your trading vocabulary by following your trading plan. If you have a strategy that has a genuine edge in the market, the most important step to success is being able to execute it effectively and eliminate your trading errors. These errors often stem from the strong emotions that come with being made to feel silly, and they can be averted by changing your mindset on what being right or wrong is all about. Change yours and you will never be wrong again.